Hello everyone and welcome to DTE's second online tax club. I hope you can hear me and see me well. Right, great. So if you're new to the tax club, then welcome. If you're one of our usual guests, then it's very nice to see you again. I hope that everyone have been well for the past few months. We've got 53 people now, but about 90 people register. So we expect that more people will be joining us as we go along. But since it's getting late now, we'll start the webinar now anyway. We have a number of different speakers today, but Alan will be introducing them to you as we go along. Now, without further ado, I will hand it over to Alan.
Hi there. How is everybody? Okay. Right. Thanks. The turnout, the people who have said they're going to join us today is phenomenal. So it's always appreciated. I hate talking to myself, as most people know. Right. Yes, we've got an interesting program today. I've got three speakers. I've got, as usual, someone from the VAT people to give us an update on the VAT world, but we've had a slight change on how I'm going to do that. The original intention was that people who think he's my son, but he isn't. We've got Rob McCann from the VAT people. And originally Rob was going to give us a topical update, but we had a rethink. So apologies for that. In fact, what will happen is we'll having Rob just going to introduce himself in a couple of minutes, but we've got a guy called David Miller. Now, I've known David Miller for probably upwards 16, 17 years now, and he's with the VAT people, and he's going to give us actually an update on all things Brexit, which I think is a damn good idea. So we're going to go ahead with that. I've got my very good friend within DTE, Sarah Nicholson, who's our payroll director. I think she's set herself an impossible challenge of some of the topics she wants to cover within the 20 minutes I've allocated to her, but we'll see how it goes. I've also then got the cream of the crop. I've got Donna from Leonard Curtis in Liverpool. Now, those of you who attend the Liverpool Tax Club in its physical form are probably all lamenting not getting the chip ration anymore. But Donna's going to cover some topical issues arising from changes of that were brought in relation to HMRC debt and what have you. However, before I pass you over to Rob and then David Miller, I'd like to cover a few topics. I have apologies if I've got a bit of a paper here, because for a change, I'm actually nearly half prepared. The JRS scheme. I don't know if any of you attended a tax investigations presentation last week online, but some interesting facts came out about the JRS scheme. One of them is that they've already got, when I say they, HMRC have 28,000 employers on their list for cases under consideration where there is a belief either through whistleblowing or factual information of cases where potentially the furlough scheme has been abused. HMRC have reliably said that they will take up 10,000 cases before the 31st of March 2021. I suspect that might be slightly optimistic, but I was speaking yesterday to a tax inspector who I have a lot of time for. He's been in the tax arena for a long time, and he's based in their nice, shiny new office down in Bristol. And he's certainly, him and his team, who previously dealt with, in the main, Code of Practice 9 cases, which is where prosecution had been considered, but they were taken as a civil case. They've been transferred over to deal with these particular cases. So I'm sure across Manchester, Liverpool, Leeds, Scotland, Northern Ireland, Belfast particularly, all of those specialists have seemed to have been diverted. The government is making it very clear that while they've been generous with funds, or they believe they've been generous with funds, they are starting now to look at the schemes and where people may have been fraudulent. The bottom line to all of that people is that you've got to look at any schemes, any claims where you've had clients, particularly where you may have been involved in the payroll production, to check that you are comfortable. And please, 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 if nothing else today, act now, okay? We're not going, David's joined us. We'll catch up with him in a minute. Right, so that's what we've got in terms of the job retention scheme. In addition, I want to make it clear, we're now entering the second phase of summer furlough, and Sarah will be covering that. But the self-employed income support scheme has been extended, if I recall correctly. I've not seen the document that's come out yet. I don't know if any of you have. Now, in the summer, when people were getting the letters through the post, the questions were reasonably easy to answer and probably not get many of our clients in trouble. I think the thing you've got to think about on this second tranche, phase 2, is, all I'm going to say is make sure your clients are careful in how they answer it, the question, because if their business has truly ceased because of the pandemic, they shouldn't really be claiming, in my understanding. So there's 1 or 2 people I know where it was questionable that they should have claimed in the first place. If they ask for your advice, please give it in the spirit of what the scheme is intended for. Now, I'm going to pass you over to Rob McCann, and then Dave, I'll just do a little bit more of half a minute about David. Then I'll do a bit more. Then we're going to have Sarah. I'll do another couple of minutes maybe. Then it'll be over to Donna. Now, Rob has told me that he is happy if people type in questions. We can try and answer some of them this afternoon. Is that okay, Rob? Just nod.
Absolutely.
Okay, good on you. Right, so Ella, if you could pass over to Rob. I've known Rob now probably over 10, 12 years. He's definitely not related because he's not as handsome as me. And I've certainly, those people who've attended Tax Club in the past will know his colleague, Steve Howard. He runs with David, Steve and others, the VAT people in South Manchester. So over to you just for a quick introduction, Rob, and then, because you're going to be doing it in future, I believe.
Absolutely, yeah. Thanks, Alan. Thanks for that. Good afternoon, everyone. Yeah, we have had a bit of a rethink about the VAT aspects of the Tax Club. And I think from now on, we're going to continue to give you updates on relevant case law, changes in HMRC interpretation law, etc. But we also want to address any particular sort of back questions or issues that you might have. And we encouraged you, I think, when we sent the invite out this time to send in questions, and a number of you did. Thank you for that.
Dangerous move that was.
Yeah, absolutely. And I will contact those that did raise those questions directly, because this time round we had a bit of a last minute change of plan, as Alan alluded to, and we thought the end of the year is fast approaching, and it will be a good idea to use our 20 minutes to talk about Brexit, not just the sort of VAT and customs duty impact of Brexit, but the practical issues that businesses are going to face if they're trading with the EU post 1st of Jan. And I think it's fair to say that my colleague David is spending his life at the moment, or certainly a large part of his life, speaking to businesses about this type of issue and helping them plan for how they're going to trade with the EU next year and onwards. So yeah, without further ado and without wanting to waste too much time, here's David.
Okay,
thanks, Rob.
Yeah,
thanks, Rob.
Okay?
I'm fine, thank you, Alan. As Rob said, my world at the moment is customs and Brexit, and sort of planning strategies around that, and really just educating businesses as much as we can as to what is going to happen. So yes, very well, thank you, Alan, and nice to speak to everyone.
I'm just trying to read what's on your calendar or whatever behind your hair, but I just can't make it out.
It's actually an old sign from the London Underground, an old London Underground poster.
Right.
So
okay.
yeah, it's my little man cave. So
over to you.
Thank you very much. Good afternoon, everyone. As Alan and Rob have said, I'm David Miller. We're actually kind of the banner of, as well as the VAT people, the customs people. And my work in life at the moment is very much sort of making sense as much as we can of Brexit and trying to impart knowledge and get businesses to think about the kind of things they should be doing to plan for the 1st of January. There's actually two elements to Brexit from a importing and exporting point of view. So we're talking about import of goods from EU suppliers and export of goods to the EU, which lots of businesses get involved with. Just put into context, at the moment, HMRC say there's about 150,000 businesses that are required to do customs declarations. So that's importing from non-EU countries. That will rise post-Brexit to 400,000 businesses. So there's about 250,000 businesses who currently don't have to do any kind of customs declarations currently, but post 1st of January will need to. And again, just to put into context, at the moment, there's about 55 million customs declarations that are made for non-EU imports and exports, and that will rise to 255 million post-Brexit. So it's a huge change. Now, it's probably worth firstly just mentioning that there's kind of two aspects to Brexit. There's the free trade agreement, which may or may not happen. Now, there is a bit of a misnomer with some businesses that if there's a free trade agreement, everything will be okay. And Brexit will kind of just take care of itself. But that's not actually true. What the free trade agreement is concerned with is actually whether duty will be due on imports from the EU or on imports from the UK into the EU post-Brexit. And that's really all it's concerned with. It's just the duty position, the actual cost position. So whilst it's very important, any business that's buying from or selling to the EU should actually be aware of the wider facets of Brexit. In terms of the actual free trade agreement, if there is no deal, we do know what duty rates will be on imports from the EU post 1st of January. The government some weeks ago issued the UK trade tariff, which lists the duty rates on all products, and there are changes to some products. Some products, the duty will be the same as it is now on imports from non-EU countries. Some products are going to have a lower duty rate, and some will have no duty at all. So that's on the gov.uk website. But putting to one side the free trade, whether a free trade agreement does come in or not, we don't know the terms of that yet. What the government has issued is a very clear framework that they've not provided all the details for every single aspect, but what they have done is provide the framework of how the UK will deal with imports and exports from Europe. Now, this is mainland Europe. Northern Ireland's a separate piece. I'm not really going to go into Northern Ireland today, only from the point of view that the information is limited. So I can't really impart that much because there isn't that much to impart other than lots of speculation. However, if we look at the framework, any business that imports from the EU or any business that exports to the EU should take some steps to plan for 1st of January onwards. So briefly sort of talking about 1st of January onwards from an importing point of view, the government have basically said there are two options for businesses that want to import goods from Europe after the 1st of January. The first is that you can do a full import declaration. So bring to account any duty, make a declaration and pay any duty at that stage. Or for the period 1st of January to the 30th of June, there'll be an easement period where a business came out, a business will have to make a deferred declaration so they can actually get their goods through customs with no customs declaration required at the point of import, and that's really to ease traffic, make sure that there aren't horrendous queues at Dover and other ports. And then within 6 months of that import, make the customs declaration and bring in duty to account when duty is due. So there's going to be some simplifications for the first 6 months, but it's actually planning when that customs declaration will be declared, because there's actually in doing an import, there's actually 3 declarations that need to be made. There's the customs declaration bringing duty to account. There's also how import VAT will be accounted for and dealt with. Now that's changing in the import VAT can be declared under a thing called postponed VAT accounting. So no VAT is paid on actual import. It's actually migrated to a VAT return, a bit like acquisitions are now on imports from Europe, but it's going to apply to all imports from anywhere in the world. So from a cash flow point of view, it helps businesses. But that declaration is actually made on the VAT period, on the VAT return when the import takes place. So if somebody's deferring their customs declaration, they just want to plan when the declaration and when the customs declaration and when the VAT return periods are actually due. Add to which Intrastat, which is of course a bane of everybody's life, whilst we're leaving the EU, Intrastat will actually be remaining. So we'll have Intrastat declarations to do as well. So from an import point of view, for the first 6 months, there's this easement. From the 1st of July 2021, any imports from Europe will require a full import declaration or the import declaration to be made prior to import. So it's moving to 1st of July onwards. It will be the same as importing from outside the EU, so it will be uniform. Now, a few very brief sort of considerations where I'm sort of talking to businesses about practicalities is a lot of businesses will trade with Europe, be it import or export on by DDP, or we buy DDP or we buy Ex Works. Well, couple of things that businesses should really consider is talking to their suppliers, talking to their customers. Let's just deal with the suppliers first. Talking to the suppliers as to how those transactions will occur, because at the moment, of course, it doesn't really matter because there's no customs borders, there's no customs declarations on trade with Europe. You can load a van up, bring it in from Europe, and it's all done on commercial documentation. But somebody will have to do an export from Europe because converse to the UK requiring import declarations, the EU will require an export declaration. Now, UK businesses post-Brexit will not be able to export from Europe. So clearly, anybody who's buying from Europe will need their supplier to be fully conversant with the fact that they will need to do a customs declaration to get UK-bound goods cleared through the European ports. Similarly, in terms of how a business buys goods from Europe, they could buy them DDP, but that would then push the customs declaration requirement back to the supplier. Now, most suppliers aren't going to want to do that because they won't want to be involved in dealing with UK customs and UK VAT regulations. Although some businesses, I mean, Rob will testify to that. He's working with a Greek yogurt manufacturer who have been told by Aldi that if they want to supply Aldi post-Brexit, they will supply DDP. So Rob has actually registered this particular business for UK VAT. They will make UK supplies and account for VAT as applicable. Now, I don't think there is that on yogurt, but they will have those obligations. To do that declaration. So, sort of on a practical level, it's really worth both UK importers and exporters talking to, sort of looking at their supply chain and deciding what do they want and liaising with their suppliers and customers. Spinning that over to exports, things are changing slightly differently on exports in that the changes that will come in on the 1st of January happen on the 1st of January. There is no easement period. So if a business wants to export to Europe, there will be the requirement to pre-lodge an export declaration before the goods arrive at the port. Otherwise, they will not be able to leave the UK. And that's something that the government's very strict on. And then this is where we get the 7,000 lorries parked somewhere in Kent from Michael Gove, because obviously there's going to be a lot of traffic going through. So businesses should sort of plan and familiarise themselves and talk to a freight forwarder or a clearance agent if they don't have one in place. I've got contacts with a few to actually sort of say, well, how's this going to happen, and just making sure that the information that's needed to make the for the declaration to be made is made in good time. Now, again, on a practical level, it's worth businesses understanding their sort of supply chain, because conversely, as well as an export from the UK, there's going to be the requirement for an import declaration into Europe. Now, one area where a lot of businesses are, when they come to us and sort of speak and say, well, how will it affect us, is, well, how do UK businesses want to trade with their customers post-Brexit? Because one thing that a lot of businesses are saying, of course, is, well, we want our customers to be as inconvenienced as possible. We don't want Brexit to be a barrier to UK businesses being able to trade with Europe and to basically have barriers to customers not buying from them. So one thing is, who's going to do the import into Europe? Now that could be the customer, whereby they take care of all the customs clearance, pay any duties, pay any VAT, but that's kind of completely outside what many customers in Europe will be doing now. They weren't necessarily doing that, and that's obviously a perceived barrier. The second option is saying to a customer, well, okay, we'll pay for the duty if there's any duty, any clearance charges, but you're still legally responsible for customs clearance. Or the third option, which a lot of business I'm talking to are looking at, is saying, well, okay, we'll actually do the import into Europe and have a strategy whereby we supply DDP and we'll take the pain away from the customer. And there's various options there. There's understanding where a client, a business is shipping through. How do they want to ship? How do they want to set themselves up? Do they want to have do it through one port, or one country? So there's sort of a number of things for clients to consider, but both on a practical basis from what do we want to say to our customers? Do we want to give them a solution to the Brexit problem? And if they do, how do they actually sort of plan that? Because you could have a situation, you have 27 customers in 27 other EU member states. You don't really want to have 27 VAT registration, 27 sets of customs clearances in 27 different countries. So it's sort of consolidating that and understanding that. So at the very minimum, we're saying to clients, look, think about your supply chain, look at what your customers want, what do you want, and plan it. And this is where we're sort of giving assistance to those practical aspects. The last element is a lot of businesses, of course, will import either from Europe or further afield and export into Europe. So in theory, if we have no trade agreement, there could be double duty, because there could be duty coming into the UK at the UK rate, and there could be duty going into Europe at the European rate. So if I give an example of one business we're working with, it's a chemical importer and distributor. About 40% of his business is EU. It imports everything from India and China, and typically the duty rate they pay at the moment is 6.5%. Post-Brexit, the UK rate of importing the chemicals will be 6%, but the 40% of the business that goes back to Europe will attract 6.5% in Europe. So clearly, we don't really want two lots of duty being paid on the same product. So there are various strategies we're working with, one of which is looking at something like customs warehousing, bonded warehousing, a lot of people will have heard of. That suspends the duty while the goods are in the UK, but no duty is paid when goods are re-exported to Europe. That's a strategy to avoid that double duty. If there's any processing, there's an alternative relief called import processing, where again duty is suspended on anything that's re-exported. So again, looking at on a wider basis, as well as the practicalities of actually how will we get Brexit to work, because it's happening. A lot of people are saying, well, it's not fair, it's not right, but unfortunately the sort of leave remain argument as long as it's gone now, and it is happening, and then the government seem to be absolutely steadfast that it's happening on the 1st of January. So it's familiarising themselves with just the practicalities, and then if there is potential for things like double duty, looking at what available strategies there are and doing some planning. It's getting a bit close to the deadline. We're only 2.5 months away now, but there are things that can be put in place. So it's really sort of engaging with clients that do trade with Europe, and understanding sort of the numbers. Business that only deal a little bit with Europe obviously impacts a lot less, but anybody's got any real volume with Europe, it's looking at these kind of planning, just to make sure if nothing else they understand what they need to do, because come 1st of January, if they export, there's no good them trying to pitch up a port with a consignment of goods if they haven't done the planning and done the customs paperwork, because they won't get through. So that's kind of a brief outline of some of the practical tips, practical tips and practical aspects of Brexit and what really businesses should be looking at. There is a lot of information that we can impart. I think some businesses are still thinking, well, there's not, we don't know much what's happening. We do know what is definitely going to happen. That's the process is, yes, we don't know the full extent of the free trade agreement, whether there'll be one or not. And that will unfortunately come out in due course, but there is a lot business can do to consider and plan and take those steps now, and those 2.5 months are going to go very quickly. So if you've got clients that are trading with Europe, is making them aware. And that's me. I mean, and if you've got any questions,
David, I was expecting another 5 minutes out of you, but don't worry, that's brilliant.
I could go on all the afternoon if people
that's
want,
what people have told me in the past. Now, thank you for finding the time in your day, because I know you're busy on another project. So I do appreciate. If you want to mute yourself now, and if we could put Rob back on. Is Rob still with us? Are you still there, Rob? I've had a question. I've just lost it. Here we go. Hi, I have a client who repairs machinery parts and has customers in the EU. They receive the parts from a customer, repair them, and send them back to the customer. They are not selling goods, just a service, but the parts are sent backwards and forwards. Where does this sit in its imports and exports? Thanks.
Shall I answer that, Rob? Because I've got the answer for that.
There we are.
Quite quickly. Right. One of the reliefs that I mentioned, so there's two reliefs on goods coming in which go back out to Europe. One's custom bonded warehousing, which is a storage relief. The other one's a relief called inward processing. So what that allows businesses to do is geared up for exactly this situation, where goods are brought in for some kind of process, so in this case repair and return, the importing business, so the processing business, can apply for inward processing. What it then means is, okay, they've got to do audit trails and sort of, meet the conditions of the relief, which is generally having an audit trail and making sure returns are lodged periodically. But what it does, it suspends any duty and VAT. Now, I know we said postponed VAT accounting applies, but it means that VAT wouldn't be payable on a VAT return. But it means that the duty is suspended on those parts when they're imported, as long as they're exported within a certain period of time. And typically, depending on how long it takes someone to do the repair, typically it could be 6 months. So there is a relief that handles that, but that particular client should really look at applying for that relief. It normally takes between a month and 2 months to obtain, so it's worth them fleshing that out now and seeing what they can do. But there is something that can be done to avoid them incurring an additional cost.
Okay, David, that's brilliant. You may now go. Right. People, I want to just cover a couple of little things before we pass on to Sarah Nicholson. A lot of you will know that for whatever reason, I seem to know a lot of accountants. And one of the things that's come up, and it happens possibly more than maybe a lot of you guys, ladies, appreciate. Would you believe there are people out there, accountants, who have had enough and actually want to get out of the rat race that is accountancy and tax advice? There is, this may hopefully be of interest to some people. I got contact maybe probably 6 weeks ago by a firm of accountants who I've known probably actually for 20 years or coming up to 20 years. And they're based in North Manchester. And they're looking to retire. The principal is looking to retire. What I'm asking is if there is anybody out there in these times, these troubled times possibly, who might be interested in acquiring a property in a practice in North Manchester. I can share with you that the turnover of the practice is in excess of £400,000. If anybody is interested, could they ring me? Don't do it as a message or anything online. If they could ring me on my mobile number of 07715 755 238, I will give them some further detail. Now, moving on. I've got a case here, a tax case, and I apologise when I do these, I obviously have to read off. There can't be many of these circumstances left. If you're old and crinkly like me, you will probably just about remember that there was a less enlightened time and this less enlightened time actually finished on the 5th of April, 1978. Now, up to that point, if a lady got married, two things happened. She ceased to be the person she was for tax purposes. And I remember when I was a very young man that a lady would write in and say, hey, I've got married, I'm now Mrs. McCann. Oh, right, okay. And you, on her control card, which was a card that every tax officer had for every taxpayer, you would write on the top her new name and put Feme Soul. And that person, the old person, ceased to exist. They kept the same national insurance number, but potentially if you timed it right in the tax year, you were two people and you got two personal allowances in that year. You will therefore have worked out from this that that's why there used to be a lot of weddings in September. Okay, going back even further, just out of a historical context, if when a man got married, again in less enlightened times, he qualified for the what was then called the married man's allowance. And if you'd got married at any time in the year, you got the full allowance for the full year, this extra allowance. You will hopefully conclude from that, you will appreciate in an earlier time why people got married in March. So March and September had reasons for getting married, and there's too often it's a financial issue. But equally, what also happened when a lady got married, she could elect to pay a lower rate of national insurance contributions. And I think it's fair to say the vast majority of married ladies would elect to pay what was called the reduced stamp. Now, what has happened is that as the final wave of those taxpayers are retiring, and if you work it out, let's just assume someone was 18 in 1978 and got married and chose to pay the reduced stamp, that would mean that really a push, if any ladies born after the 6th of April 1960, it's no longer relevant. So there is a very small number of ladies left who will have paid the reduced stamp. The big thing that's coming out though, and has been boiling now for a number of years, is that a lot of these ladies, when they're told what their state pension is, they are aggrieved on two counts. One is that they sent in this election, but it wasn't fully explained to them, or they never sent the election in. The part of the problem is, particularly with the latter group, and this is the case I'm now going to make reference to, that was heard in the tax tribunal at the first tier back in June. And what we had, it was that did this lady sign the reduced election to pay the reduced rate of national insurance? The taxpayer, T, appealed against HMRC's decision that she was due to pay the married woman's reduced rate of NIC from 1975 to 1978, because after 78 it was abolished and everybody had to pay for want of a better phrase, the full rate. In that period, she did not work and was living in Germany with her husband, who was in the army. HMRC claimed that she made a married woman's election not to pay national insurance contributions under the then Regulation 91 of the Social Security Contributions Act, and that her Department of Health and Social Security record form RF1 contained a note to that effect. The taxpayer denied that she'd made such an election. The first tier tribunal noted that HMRC were unable to produce any documents to show that the taxpayer had made a Regulation 91 election, but said that they had set out a reasonable case to say that she had signed the form. Mrs. T's account of where she lived and when she was working was consistent and plausible. There was a dearth of independent corroborating evidence, but the judge could detect no deliberate untruthfulness. Further, her memory for this period was likely to be accurate because it was such a memorable time in her life. She married, moved abroad, and had 2 children. There was also inherent improbabilities that she would have been able to make an election given her movements when the form would have been signed. The judge found that the taxpayer had not made the election and allowed her appeal. So you can see the issue there is that there's potentially a shortfall within her contribution record, and the HMRC, who were the successors of what back in the days of when I was a lot younger was the Department of Health and Social Security, which grew into the Contributions Agency, which as the 1990s evolved became part of HMRC. The big problem is when records got transferred onto computer systems, not digital, but computer systems of an earlier time, papers will have got lost. I find this, going off at a slight issue, I find that totally the likelihood. I spend a lot of my time pulling out rabbits out of the hat with HMRC when they say there is no evidence, and I let them babble on for 10 minutes and then produce a letter from 2001 or 1997 and say with a very straight face, so you're telling me you haven't got a copy of your letter dated the 27th of July 2003? You say, what letter? And I pull it out and give them a copy. And they go, oh, bloody hell. So there's 2 aspects here. If you do have people who are approaching their retirement, who potentially were born no later than certainly 1960, but even at a push 1962, you should now be doing your pension forecast checks for these clients if they want to, or point them in the right direction. It can be done through the post or it can be done online. And if there is this shortfall, get into the regime of the argument before retirement, because at least you can argue it well before any pension forecast is formally used to determine someone's pension. So just bear that in mind. Right, going forward then. We're now going to move over to my colleague Sarah Nicholson. Are you there, Sarah? Are you with me? Right, I've known Sarah. How long have I known you now?
15 years.
As long as that? God, seems longer. Sarah's our payroll director of one of our allied companies.
You promoted me there.
Hey?
You promoted me.
Yeah, oh,
I'm not quite a director.
I always, well, whatever you are then. She's done a list of things she wants to cover. I'm just going to say that broadly, it's going to be a topical update of things that have happened since the 6th of April of this year, but with some very specific areas that you want to get over to the people who are listening. Is that fair?
Yeah, that's fair, yeah.
Right, over to you, my friend.
Okay, then, let's start. So obviously since the lockdown, everything sort of moved pretty quickly. We had to do the tax year end remotely, but luckily we were prepared for that. So we had the minimum wage that came in, the main wage going from 821 to 872. The employment allowance, there was a few changes to that, some extra criteria added, which included the employer's NI 100k cap. So anybody paying over that could no longer qualify for the employment allowance. Parental bereavement and leave pay came in from April 2020. This is to do with parents or carers who lose a child under the age of 18 or a stillbirth at 24 weeks, 2 weeks pay if they're entitled to it. The personal allowance didn't change. The tax rate stayed the same except for Scotland. The national insurance went up to 792 for the primary threshold and 732 for the secondary threshold. Student loan went up to 19,390 for Plan 1 and Plan 2, 26,575. And the postgraduate loan stayed the same. SSP went up to 95.85 and maternity pay to 151.20. That's just a quick recap of the changes that happened in April. What we do find when I take on new clients is a lot don't actually know about the employment allowance, which I'm quite surprised about. I took one on last month. They can't claim it this year because they're over the 100k, but I've been able to put a back claim in for 4 years. So we're looking at £16,000 that I've made for them just by outsourcing to us. So that's something to be aware of. This was something Alan mentioned earlier regarding the minimum wage and the furlough amounts. The furlough amount is calculated on either the pay in February 2020 if they're a fixed pay worker, or an average of the 1920 tax year. So effectively, any minimum wages that went up in April weren't taken into account in terms of the actual furlough amount paid.
Can I interject there,
Yeah.
Sarah? Because you and I have had a recent case, people, where we are now in the middle of a national minimum wage review by a chap in HM Revenue and Customs. And as it is, it's all done over the phone or through emails. But we believe what has happened here is that a disgruntled employee who subsequently left one of our clients who we do the payroll for made exactly that point and said that he'd been underpaid his furlough monies because he should have been calculated by reference to the new rate of national minimum wage, albeit that that's incorrect, as Sarah's just said. He won't have given them the full detail, but we believe it has definitely led to this particular company being looked at, which is a sizable manufacturing business with certainly 15-20 million pound turnover.
Yeah.
So you can see where some misunderstandings can arise.
Obviously, any work performed from April must have been at minimum wage, and any training that was maybe undertaken during furlough, that must have been paid at the new minimum rates from April. I'm just going to mention just a couple of sort of pitfalls in regard to the minimum wage, which obviously Alan will be quite aware of with the inspections that you've faced. Quite often, people don't realise that uniforms, the deduction from them can affect minimum wage. Even if you're sort of saying, can you wear black boots or black skirt, that can be deemed as you enforcing them to wear some type of uniform, and then that can be deemed as bringing them below minimum wage. Maybe doing a bag inspection, maybe clocking on and off. If there's extra time incurred doing that, then HMRC might see that as being additional time worked and not meeting minimum wage. Another is the sort of the salary type thing, paying a fixed monthly amount and them not being deemed as a salaried worker, more a timed work employee. And therefore, they could see that as paying them below minimum wage. The £1 admin fee that you can take for attachment of earnings due to the administration of it, if you take that and they're being paid at minimum wage, that again will be seen as bringing them below minimum wage. And also salary sacrifice. So if you offer a pension scheme that's salary sacrifice, vouchers or a bike, you need to be aware that that can affect the minimum wage, because that can bring them below the minimum amount to be paid. What our system does is if they change age or if they go into a pension scheme that is salary sacrifice, we're aware to check that and make sure to increase the rate so it doesn't bring them below minimum wage. In terms of apprenticeship rates, they can be on that for up to 19. Once they turn 19, they can only be on that for the first year. After that, they must go up to the rate for their age. And just to mention the living wage, that is different to the national minimum wage, and that's just a rate that businesses can choose to pay, but it's not a statutory obligation. Just a quick one on salary sacrifice and the exemptions. There was some changes brought in April 2017, which meant that a lot of the advantages from the tax NI were removed under the arrangements. Some of the benefits that still come under that are your childcare vouchers, your cycle to work, pensions and advice, ultra low emission cars, and then the opting in and out of a salary sacrifice a lifestyle change, COVID-19 was added to the list as acceptable to come in and out of a salary sacrifice change. People just need to be aware that you should be changing the contract and bearing it if people do go in and out of a salary sacrifice.
Well, again, both you and I have had a recent case of that, haven't we, whereby this particular client, they've had a pension salary sacrifice arrangement for upwards of 3 years. And literally weeks just before the lockdown, HMRC opened a compliance check in relation to the general company issues. And one thing that we came across, Sarah and I, was that we could not find, and no employee could find any paperwork saying they agreed to go into the salary sacrifice. They'd done everything else right. And it so far is one of the few situations where lockdown has worked, because I have to be honest, we sent a reply that bordered on being a load of highfalutin waffle, but they said fine and moved on, because we said we had a meeting where it was discussed and they accepted the meeting as being effectively the implied contract. So it is something very important to make sure that you do document correctly salary sacrifice.
Because if they deem that you've not done it correctly, then they could be looking for the tax and insurance that you've had the saving of. And in regard to the salary sacrifice, in terms of the calculations for the retention scheme, when you did calculate the 80% figure, you had to do it on the post-sacrifice pay, not the pre-sacrifice pay. And therefore, the grant had to be paid in full to the employee. So any sacrifice became an employer cost because you couldn't make that deduction from their furlough money. So we had a lot of, we've had a lot of payrolls where we've had to kind of gross up the furlough pay to calculate the pension, and then that has then gone across as a cost to the employer. Just to make you aware of that. Just to say that the claims for the CJRS will close on the 30th of November. So anything that needs claiming must be in before then, otherwise you won't get the claim money back for it. I understand that any lockdowns now, such as Liverpool City, will be able to use the CJRS scheme up to the 31st of October and be able to pay 60%, or claim 60%, but will still have to pay the employees 80%, so there'll be a 20% cost on that. Just to mention such things as maternity pay, etc., when you're calculating them, which will be about now, people that are handing in MAP B1 forms, that you've got to do it on the normal earnings, so you can't use the furlough amounts to calculate the SMP amounts. You need to work out what would be their normal pay. And then notice pay, if you're paying that within the furlough scheme, then it must be paid at the normal earnings, so you need to take that back up to 100%. You can still claim via the retention scheme for any notice pay as long as it's not in lieu, it's worked notice. Can't claim for any redundancy via the grant. The new job support scheme that's going to be coming in from the 1st of November, this is completely separate to the retention scheme, so you don't have to have been on furlough to be able to go onto the JSS. But employees must have been on an RTI return on or before the 23rd of September to qualify.
Can I just interject there? I think the people who came to the last virtual club, I mentioned this situation where we had one client who, for whatever reason, the RTI returns had not got submitted for most of tax year 2019-20. Now, I think last time I spoke, I said we'd been trying to attempt for HMRC to agree that it was immoral that they were taking the money off them every month prior to the lockdown without ever asking the obvious question, why are you sending us this money? In a roundabout way, through a little bit of my network within HMRC, I managed to get someone to look at it again, and the answer was the computer says no. So we've had to go to the adjudicator. I have to be honest, the likely success is less than 50%, possibly lower. And the concern we've got here is at stake is £70,000, which is a considerable amount of money. And we're not sure if the company will survive, actually, if we're unlucky. I suspect we won't. I've actually told them that if they are going to think of doing something with the reduction in workforce, and we've got to make sure we've got the RTI returns in for the present period. Because as you said, what was it, the 23rd of September?
Yeah, for the new scheme, yeah.
So that would be tax month ending, or the August tax month, really, isn't it?
Or it could be September, depending on when you put. I mean, this was the issue the first time round with the scheme.
If you're on a weekly, the
starters that came on at the end of February lost out.
Right.
If we didn't see RTI until the end of the month,
We'll sort of share that with you. Back to you, my friend.
So on the JSS scheme, they can go on and off the arrangement, but it must be for a minimum of 7 days. It's available to small to medium employers. Large employers could potentially go on it, but they've got to do a financial assessment and prove that turnovers are a third less due to the pandemic. The cap for the claimed part will be £697.92, which is the element you'll claim back from the government. So they're going to pay a third of the employee's unworked hours. While this is happening, the employee can't be made redundant or put on notice because they're supposed to have a viable job to utilise the JSS. So it's slightly different than the CJRS in terms of that. It'll run for 6 months from the 1st of November to end of April, following the closure of the CJRS. And the usual hours, which is ideal if you've got fixed hours, but we have a lot of payrolls where they don't have fixed hours. We assume it'll probably be done something similar to the flexi furlough, where you'll be going back and working out an average to see what their usual hours would be, to be able to work out what a third is, to see that they meet the criteria and then pay the balance. So they must work a third of their hours to qualify. And then the non-worked hours will be split 3 ways. So the employer will pick up a third, government, and then the employee will lose a third of the hours not worked. They must be in writing to be able to do it, and this can be audited by HMRC, so it's important that employers keep these letters documented. And the government, the third that they pay back, there will be no on-cost with that, so there'll be no claim for employers' NI or pension. It will just literally be the payment. The payment's going to be paid in arrears, which is different to how it's been paid through the CJRS. So you could claim if your payroll was imminent. It's not going to be done like that. So really, you've got to have that money there to be able to pay it through the RTI and then claim it back the following month. The claims should start from December 2020, and we're waiting for further guidance on how that will be, but I would imagine it'll be very similar to the CJRS. They've also expanded it for any businesses that they've asked to shut, but only businesses where they've asked them to shut. And this is where the government will pay 2/3 or 67% of the pay, up to a cap of 2,100. And the people at this point must be completely off for a minimum of 7 days to be able to claim this expansion of the job support scheme. This will run for 6 months and it'll be reviewed in January 2021. And again, paid in arrears, and the claims will start in December. This then follows on with the retention bonus, which is to do with the retention scheme, not the job support scheme. And this is for any employees who've been furloughed during that time, but they must remain on the payroll between November and the end of January to be able to claim the £1,000 retention bonus. They must earn at least an average of £520 during those months to be able to put a claim in for them, and they mustn't be serving the notice on the 31st of January. If HMRC decide that there was any incorrect claims via the CJRS, then they won't be eligible to get the retention bonus. Just a quick one, there's SSP rebate scheme. So this is to do with any SSP that's been paid out due to COVID-19, where the employee didn't have to serve the waiting days and they could get SSP from day one. So if they were self-isolating or had COVID, the employer can claim back up to 2 weeks for each employee, but there must be less than 250 employees to be able to do that, and they must have been on the pay-as-you-earn scheme on or before the 28th of February. Just another quick point, the holiday pay went from an average of 12 weeks to 52 weeks. So when you calculate an employee's holiday pay, if they're working variable hours, you must go back 52 weeks to work out what their holiday pay is for any time taken. This must include any overtime, whether it's voluntary or regular, and any commission, and there is some other items that must be included in this. So if anybody's taking any holidays, which could have been reduced by furlough, you will have to work it back up to what would be their normal earnings. And one more point to make is re-enrolment. We've gone through quite a lot of that again this year for the ones who've done the 3-year enrolment. And it's just a reminder that you've got to put anybody back in that has opted out more than a year ago, if they meet the criteria to go back in. I think that's majority of the bits and pieces for now.
Okay, well, thank you for that. Bearing in mind you didn't think you could last that long.
No.
That's brilliant. Thank you very much. Right, let me cover a few more points before we pass over to Donna. Right, I don't know if you're aware, HMRC are pushing hard for principally tax advisors, and I suppose by that definition, accountants, all to be regulated in some way. I suspect if they had the way, it would be themselves regulating us. The vast majority of people who attend the tax club and the people who I do work for are associated or linked to some form of professional body, so therefore regulation is in place. I suspect really they would love something not different, akin to the Law Society, but just please be aware this isn't going to go away. If you are worried that you're not in a regulated body, you should give some thought maybe to seeing which one you could join, just to really to have the appropriate body over you before HMRC tried to impose something. If you all recall, when the money laundering issues took off, if you weren't with a regulated body, you had to register with HMRC. So I suspect they have a list of potentially most practices or businesses that aren't allied in some way to a professional body. It'll be interesting to see how it develops, but just please keep it in your mind. If you're old like me, it might even be a one way of thinking, or might not want to live in this new age. Right, I say this so often, it's boring. Please don't forget, it's not gone away. IR35 for businesses is still relevant from 6th of April 21. If you do have clients where you think it's going to impact and you've not discussed things with them, you should be sitting down now and discussing these issues with them. Something I ask all the time. I hope that you all read the HMRC agent update. The last one was pretty good. If you don't read it, please make the effort. Either read it just by reading it on your screen later, or if you like me, an old-fashioned running a copy off and using up loads of ink. But it is worthy of reading. Okay, it's written in a way that HMRC want it to be written, sort of telling us what to do. But in the most recent one, which I think was for September, it did cover all the things like the new trust registration service, how you have to be go about being registered with them so that you can put new trusts and settlements on the system. Please make an effort to have a look at that. Right. I want to read one case to you here, and in a way I could argue it sort of is linked to, in a way, to payroll matters. I apologize, it's a bit boring, but please let me just tolerate me on this. This is to do with domestic care workers and their mileage, and the issue was whether a domestic care worker's travel costs could include mileage to and from their home at the start and end of each day. The facts were as follows. Domiciliary care workers are one of the few categories of worker that can legitimately claim their home to work travel costs as tax deductible. This claim is either under section 337 of ITPA, because like a service engineer who moves about from place to place during the day, carrying out repairs, their duties inherently involve travelling, or because it is likely that many such workers, every place they attend qualifies under the temporary workplace rules. Fine. In this specific case, A was a care worker, and HMRC sought to calculate a care worker's mileage on the basis of travel undertaken while working only, and not including the travel between her home and the first and last jobs of the day. So I'm sure you can all see where revenue's standpoint is here. HMRC also raised the issue that the records of the individual and employer prevented an accurate claim to be made. The care worker concerned made an appeal. The first tier tribunal disagreed with HMRC, which is always good news, isn't it? And found that travel between the care worker's home and the first and last jobs of the day should be included based on the nature of her work. While there were some errors in the taxpayer's own mileage calculations, the first tier tribunal, in calculating the correct mileage, including home to work mileage, resorted to using records recreated retrospectively based on samples of scheduled client visits pulled from her employer's system, extrapolation, and using Google Maps. So the taxpayer's appeal was allowed. And I think the points to make here is that if you ever take, when you're really bored with life, if you ever take the time to read booklet 490 of HMRC's stock of guidebooks that they produce, it has more examples about how when situations create allowable travelling than any other booklet I'm aware of. And I think the conclusion is right. This person probably starts work from the moment they drive off the drive, no different to, say, a British gas engineer or a travelling salesman. So just bear that in mind. I'm not suggesting you start offering your services to offer refunds to all of the care workers, but if you do have people you're aware of who are in those particular types of industry, and they travel about all day and every day, then yes, you should be looking to see what the rate was. And if appropriate, claim back for, 4 years possibly, together with a code number revision going forward. So just bear that in mind. Right. I know I've over to Donna now, I think, if you don't mind, Ella, bringing Donna up. Donna I have known for about 3 or 4 years. Some of you will have met her, those who attend the Liverpool Tax Club. She's with the nationwide insolvency business, Leonard Curtis, and she's going to cover some issues. So over to you now, Donna, please.
Hi, thank you for that, Alan. Hello, everyone. So my name is Donna Crompton, and I'm a director based in the Liverpool and Chester office at Leonard Curtis. And today I'll be updating you on the new legislation which will impact on the way funds are distributed in an insolvency. However, before I do this, I'll introduce you to what we do at Leonard Curtis. So Leonard Curtis is a national firm. We have over 20 offices in the UK, and it employs over 24 insolvency practitioners and over 220 staff. The main business is insolvency, but we have other divisions within the company that can help you and your clients. For example, we've got a time to pay. Our time to pay works closely with the revenue. We have an in-house brokerage, which is Reach, and they have access to funders of all types, be it loans, factoring, mortgages, stock loans. And we also have our in-house legal team. We have some lawyers who can speak to you and your clients if you have any legal issues. So insolvency is mainly what we do, but we like to be able to offer a lot more than any other firms can offer. So, okay, onto the topic in hand. So under the Finance Act 2020, HMRC regains its status as a preferential creditor for all insolvencies on or after the 1st of September 2020. The ranking means it will be a secondary preferential creditor after employee claims. HMRC regard themselves as an involuntary creditor, and as such, it could be argued that they should exercise better credit control. The last time the Crown had preferential status was to September 2003. It was abolished to make the insolvency process fairer on unsecured creditors. Now, there has been a turnaround, and the main reason for the change is to boost Treasury takings, which are reportedly set to rise by 185 million a year. This increased tax revenue will fund public services, but does it come at too high a cost for the SMEs that make up the majority of the unsecured creditors in a liquidation? And doing this during a pandemic when businesses are likely to fail is perhaps poor judgment when lenders may apply more pressure. Currently, generally, only certain employees rank as preferential in an insolvency procedure. However, in a few months' time, HMRC will become a secondary preferential creditor in relation to taxes paid by employees and customers held by a business on their behalf, such as PAYE, VAT, employee NIC, and CIS deductions. I don't know whether you can still see me. Something's just come up on my computer. Crucially, the legislation does not include a cap on the age of tax debts that have preferential status. HMRC will remain an unsecured creditor for corporation tax and employer NIC contributions. This means that in an insolvency process, HMRC will move up the rankings of who will get paid first, jumping ahead of floating charge holders and unsecured creditors. HMRC's general description of this measure is when a business enters insolvency, more of the taxes paid in good faith by its employees and customers and temporarily held by the business will go to fund public services rather than being distributed to other creditors. Again, why allow anyone more than 3 months credit? Because if they don't, it puts a return to creditors in jeopardy. And businesses in the months and years to come, it's going to be tough enough for them. So, a reduced returns for unsecured creditors. HMRC can be one of the largest creditors in insolvency. Moving up the ranks means that's what we see, funds that would have been available to be shared equally among creditors, unsecured creditors. In general terms, the return to unsecured creditors by way of dividend is generally relatively poor, but it will have a significant impact on the secured lender. So what are the risks for creditors with a floating charge holder? Well, HMRC's claim in respect to the taxes will now take preference over any floating charge held by the secured creditors. In addition, the prescribed part, which is basically where some of the funds that would ordinarily be available to the floating charge creditors are ring-fenced for the unsecured creditors, which was introduced when the Crown preference was previously abolished to balance the position, has been retained, and in fact the limit has now increased to £800,000. So in a pre-insolvency planning, if a borrower in a lending portfolio is suffering financial stress, these new rules may change options. The options available to the secured creditors may look at increasing the director's personal exposure by way of a PG, but in some cases, enforcing insolvency may also reduce the return compared to consensual restructuring options. So it reduces the options. So what should lenders do? Well, lenders will need to consider the tax position of potential borrowers when conducting due diligence and assess what impact it may have on unsecured debt of the floating charge security. They should require their customers to deliver better and more regular information on any changes to their tax affairs and HMRC arrears in order to understand when the HMRC debts may be increasing, especially at the moment when businesses generally have higher than usual debts. Lenders may also require the more vulnerable businesses to maintain reserves in a ring-fenced account. Also, the emphasis will be on tax due diligence. With a reduced security value, lenders may deal with their increased risk by sanctioning fewer business loans or increase the cost of the business borrowing in general. So what impact does this have on businesses? Well, given that lenders will need to carry out further due diligence when assessing the business for lending criteria, as well as ongoing monitoring of the level of the HMRC debt, this may increase the cost of borrowing, and these additional costs could be passed to the customer. The time involved to conduct the enhanced due diligence will also increase and may cause delays for the initial lending decisions. Businesses who are previously qualified for lending may find under the new criteria that they no longer qualify, or that lending is reduced to take into account the additional potential loss to the lender. This could have a detrimental impact to businesses' ability to secure lending. Lenders may also look to create fixed charges over specific assets rather than relying on the floating charge or looking to the directors to provide some personal guarantees. So the conclusion, the government has advised that whilst it anticipates that there will be some impact on creditors, it does not expect this to be significant, and only a small fraction of financial institutions will no longer recover under the floating charge. Time will tell, but COVID-19 pandemic and the difficulties companies will face, I suspect the timing is totally wrong. Thank you. Alan, I can't see you, so you've sort of like gone off.
I'm here.
Oh, hi. Sorry, Alan, that was maybe a bit shorter than what you anticipated.
In the vacuuming.
All right.
Right, thank you for that, Donna. Right, a few things I want to cover before we call it a day. We're probably in no better world than we currently are with regards to getting a time to pay arrangement. Donna alluded to one of the services there that Leonard Curtis can offer. I hope you're all aware that there was a press release at the beginning of this month on the 1st of October, whereby they've said from the 1st of October, self-assessment taxpayers can apply online for additional support to help spread the cost of their tax bill into monthly payments without the need to call HMRC. It's going to be online, as I've just intimated, and the online payment plan service can already be used to set up instalment arrangements up to £10,000. So up to the end of September, it was 10. From the 1st of October, they've increased that figure to 30,000. Now, obviously, deep down, I'd prefer clients not to do that themselves, but ring me. I have to say, some of the arrangements I'm getting at the moment for clients are unbelievable. I've got some that are going on for 24 months, some for 12, even modest amounts, they're allowing 6 months to clear. Clearly, with pay-as-you-earn and national insurance contributions, the deal always has to be that currency is paid on time going forward. But don't be afraid of ringing them. if you go on the revenue website, you probably find what is called the agent dedicated telephone line with debt management and banking. That was set up back in 2009 when we had the financial crash, and HMRC responded by giving us, the agents, a line which could cut out, you know, that awful music that you get. Equally, though, I have to say, you still have to put probably up with the awful music on average for about 15 to 20 minutes. But it provided you're well rehearsed, you've got the client present. If it's corporation tax, PAYE, VAT, you should get on the phone to the revenue and get something organised. They're not looking to make anybody bankrupt. They're not looking to wind companies up. They will ask questions, as always, and these silly questions that they come up with, like, have the directors tried to borrow any money to put into the business? Obviously, you have to be careful how you answer that, but the normal answer is yes, but we can't. So bear that in mind, that time to pay probably is in a good place in terms of good place in that you can get the relief, the easing, not necessarily good place that you've got the debt in the first place. They will ask questions also on things like, were employees furloughed, have they come back to work, etc., etc. Right, what time is it? It's 10 to. Right, I just want to cover maybe one or two other tax cases that have caught my attention. And one of them, I find it, and if ever I found a tax club member who even tried to agree with the taxpayer on that, I'd be a little bit disappointed. Right, this is what the heading is: no capital gains tax relief for 3 homes sold in 3 years. And the issue was whether a taxpayer who made gains from 3 homes in 3 years was entitled to claim each had been their main residence. We've all come across this, haven't we? Right, these are the facts. I'll let you make your own mind up, and hopefully well before I get to the end of this summary, you will have made your mind up. Between 2013 and 2015, Mr. H bought and sold at least 5 properties, of which 3 were the subject to this appeal. One was sold in 2013-14 with a gain of 32,000. One the next year with a gain of 81,000, and one the year later, tax year later, with a gain of 97,659. Mrs. H argued that she'd lived in all 3 properties as her principal private residence, don't we all? And so she was therefore entitled to the PPR relief. Taking each property in turn, HMRC argued that the first, which was purchased in March 13, was listed for sale a few weeks later on the 10th of May and was sold on the 18th of September at a gain. Mrs. H explained that she was pregnant and her husband worked in Slough, so a decision was taken to move back to Slough. Okay. The second property was bought in November 13, which is what? 7 weeks after that other one was sold. And it was put up for sale on the 14th of Feb and was sold on the 6th of June of 14. Again, as we said before, at a gain. Extensive work was carried out to the house during the taxpayer's ownership. The decisions to sell was attributed to, apologies, to an incident where her husband saw 2 youths trying to break in and enter the property while he stood outside, leading the taxpayers to believe that the property was not ideal for bringing up a young family. The third property had an equally short period of ownership. HMRC noted that it was bought in September 14, listed on the 3rd of October 14, so what's that, 3 weeks, and sold the following July at a gain. Again, extensive work was carried out. The decision to sell reportedly arose from the issue that the property had previously been used by criminals as a cannabis farm, and the previous owner, who lived next door, subjected the taxpayer's family to ongoing harassment. Mrs H relied heavily on HMRC's guidance, putting particular emphasis on the argument that the homes had been her only or main residence during the respective periods. HMRC claimed Mrs H's PPR had been an entirely different property throughout the 3 years under appeal. They pointed to the fact that Mrs H had obtained a Volkswagen car with finance in April 13 and had opened a Barclays bank account in July 13, giving her address for both applications as the fourth property. Child benefit records also confirmed her children were all resident there, and electoral roll data confirmed that she had been resident for 11 to 15 years at this other property. You'll be gobsmacked to hear. The first tier tribunal said it was clear that H was trading in property with the short periods between the acquisition and disposal of each property to gain after undertaking improvements became indicative of trading. This was not an argument HMRC had put forward, as if it had been upheld, the taxpayer could have been assessed to income tax. Quite rightly, in my opinion. The first tier tribunal said that to qualify for principal private residence relief, a taxpayer must provide evidence that their residence in the property showed some degree of permanence, some degree of continuity, or some expectation of continuity. I have to say, I hope everybody, all 60 odd of you, have see that would be a hopeless case. I'm presuming she was unrepresented. She thought she would play the system, but if you're going to play the system, you've got to work in the system and operate within the system, and therefore be able to say, we're on the electoral roll, we're in the local golf club, we go to the local Labour club, whatever, all of that. The kids are enrolled at the school round the corner or go to a nursery just down the road. None of that was here. So just bear it in mind. In my opinion, it was simply purely a try-on. Right, just finish on this one, and I think we'll just do it on time. This is about capital gains tax arising on a transfer to a relative's company. This chap and his brother jointly owned a shop premises with flats above it, okay? In 2006, one of the brothers was convicted of a crime, and a confiscation order was imposed against him and his brother for £212,000 each. The brothers were unable to raise a mortgage over the property to obtain funds to pay off the debt. As a result, the property was transferred to a relative's company so that a mortgage could be raised. Okay. Although the property was subject to restraint orders granted in 2008, the High Court granted 2 variations to the restraint orders to allow the sale of the property to this limited company. The Land Registry form, the TR1, reported a transfer of the property for consideration of £499,000. The section for declaration of trust was left blank. In April 2018, another company, which was owned by a third brother, purchased the property off the other company that was owned by the relative for the said same figure of £499,000. HMRC found that the first brother had made a disposal for capital gains tax purposes, and as the sale had been to a connected party, a market value of that disposal was needed. HMRC issued a discovery assessment for the capital gains tax and the penalty, and that came to about 50k, the two together. The brother appealed, arguing that the transfer to the property was not a capital disposal, but a transfer to a family member on trust, and the brothers retained beneficial ownership of the property after the transfer. The first tier tribunal found that under English law there had been a disposition of property in May 2012, pointing to the conveyancing document. The first tier tribunal also found there was no trust, that there was no legal document to evidence the appointment. The judge made the point that a bare trust cannot simply be willed into existence in the absence of a valid legal instrument to declare it as a trust. The point to make here, I think, is very simple. I hear too often people saying these shares are in trust, or they're held as a bare trust, or they're just for a nominee, it's still mine. You have to understand, in this modern world we now live, that doesn't hold any traction. The days of hiding property in the nomineeships and everything have long gone. Saying that, I do have a degree of sympathy for them, that perhaps if they'd have done this right, that limited company might have had a legal title but not beneficial ownership. It might have worked, but as we all know, the biggest problem with these cases is that people are not prepared to spend legal expenses to achieve the result that they're looking for. They try to do things as they read on the internet or whatever. So please just bear that sort of facts in mind when you come across clients who say they've created a trust or there's some form of nomineeship. Right, with that, I can see people are getting bored because the number of people leaving is growing. Thanks for attending. We'll do the next one, hopefully, Ella, before the Christmas break. I do appreciate everybody staying loyal to me. If you want to speak to me on anything, by all means, give me a ring on my mobile this afternoon or anytime, 07715 755 238. Look after yourself, and I'll hopefully see you all soon. Bye now.
Right, thank you, Alan. Because we have another event coming soon for Connect members, I won't be keeping you any longer. Thank you for attending. And I just want to quickly remind Connect members who are booked onto the next webinar at 2 that it's a different event with a different joining link that my colleague Karen has sent to you. So it's not on this one, so don't stay on this one. Right? And that's it. Until next time, take care, everyone. Bye-bye.
Bye-bye.